Hello, Grace. Hey guys, I'm gonna give a good minute or two for other people that are just joining, so hang tight. We'll start shortly. Those of you who just joined, we'll start in about a minute. Just give some last minute attendees a chance to start from the beginning. Okay, let's begin. Good evening, everybody. Thank you for joining me tonight, rather. It's a really good time of year to talk about plan giving for a couple of reasons. End of year is a popular time of year to kind of shovel in any deductions that you can, and if you're donating cash or stock, I think it's helpful to have a sense of the benefits that you could reap from making donations from a tax perspective. It's Giving Tuesday, also another great excuse to host a webinar like this. And lastly, we are very excited to offer stock donations on behalf of Pet Project Foundation. So I will be sure to include kind of the process for doing that when I talk about donating stock and the benefits of doing that. The presentation will be roughly 25-30 minutes long. Plenty of time for questions at the end, but also feel free to chime in if there's something that you want to point out during the presentation. Feel free to send a question in the chat box or unmute yourself and ask away. I want this to be kind of collaborative and engaging, so feel free to ask anything that's in your mind. No stupid questions here, none at all. And also, you will notice some of our furry friends throughout the presentation. These are, for the most part, are available dogs, cats, and rabbits. I know Felipe was adopted recently, so unfortunately he's off the market, but they're all looking for their forever home. So if you or anybody you know who's looking, we encourage you to inquire with us on a specific pet or any just any types in general. We'd love to hear from you. Okay, so you can all see my my slide here, right? The disclosure slide. I think you guys are good there. Um, Before we do begin, I do want to disclose anytime we talk about financial planning, tax, legal advice, I do want you all to know this is for informational purposes only. It's not intended to be individual advice. If you do need individual advice, please seek out guidance from a tax, accounting, legal, or financial advisor with guidance on your specific situation. Okay, so today there's really like I'd say four kind of categories in which we're going to be talking about plan giving. So one is the type of assets that you can give. The tax implications, super important. When to donate and how to donate. Some of these donation types are easier than others. So for the ones that are require a little bit more of a heavy lift from you, I want to make sure the process is as clear as can be. So terminology, a fun little primer on some topics that I'll be talking about throughout the presentation, just so you're not kind of wondering what's going on while I'm talking about it. Number one, brokerage account. So think of this as your plain old investment account, not a retirement account. Those are different. So when I talk about a brokerage account, a taxable account, an investment account, these are all synonymous with each other. Mostly I'll be saying brokerage account. So just to avoid any confusion. Unrealized and realized gains and losses. These are really any securities that you buy where you have a realized or unrealized gain or loss. Most commonly, we're thinking about stock in that regard, but it could be a bond, it could be a mutual fund or an ETF. So throughout the presentation, we're going to be focusing on stocks, but it could be a bond or it could be a fund as well. And probably goes without saying, but if you've purchased a stock and it's gone up in value, but you haven't sold it, it's an unrealized gain. If it has a loss on it and you haven't sold it, it's an unrealized loss. And of course, when you finally go to sell the position, if you sell it at a gain, it's a realized gain. If you sell it at a loss, it's an unrealized loss. All of these obviously have tax consequences, and the length in which you've held the security has consequences on how much you're taxed on it too. I'll talk about that in a little bit. Your individual retirement accounts or your IRAs, which I'll be referring to throughout the presentation. These are your retirement accounts where distributions that you take from it are taxed at your ordinary income tax rate. Today, I'll be focusing on traditional IRAs. The traditional is synonymous with pre-tax, meaning when you contributed to an IRA, or maybe you had a 401k and you rolled it into an IRA, you made pre-tax contributions, which means when you contributed, you lowered your income for that year. But when you bring it out eventually, it's taxed at your ordinary income tax rate. The traditional IRAs are where the donations are most powerful. Roth IRAs, you already paid the tax before you contributed to it. So you can take any Roth IRA assets out tax-free. So there's really no utility to donate Roth assets. So today's conversation, traditional IRAs. Required minimum distributions. These are, or RMDs for short, these are distributions you have to take from the IRA or 401k account that you have. It's the IRS's way of saying, we've let you have this tax deferred growth for years, if not decades. Now it's time for us to collect the tax that we've let you defer until your later years. The amount that you have to take is kind of a tricky formula. It's based on the December 31st balance of your account, and it's divided by an IRS life expectancy table. So it's basically based on your age, more or less. The first year in which you need to start taking RMDs is age 73. There's a weird caveat with the first year where you actually don't have to take it in the year you turn 73. You can wait until April 1st of the following year. But then you have two RMDs in the same year if you wait. Quick sidebar there. RMDs will go up to age 75 around 2033. But just know for now, if you're 73 or older, you have to take RMDs from your pre-tax IRA and 401k accounts. Qualified distributions, charitable distributions allow you to donate a portion or potentially all of your RMDs from your IRA. It's weird because they're allowable starting in the year you turn 70 and a half, which the R&D year and the QCD year used to be the same. Now you got essentially 2.5 years in which you can make QCDs where you don't have to take assets out in the form of an R&D. So an interesting wrinkle there with all this, where most of the time you're thinking about, oh, I've got an RMD, I want to donate part of it, but you can actually start before you have to take from your accounts. The limit for QCDs, it's a universal limit. There's no weird RMD calculation that's specific to the account holder. The limit is 108,000 per year for this year. It goes up to 111,000 for next year. Usually it's tied roughly to inflation. And it's not technically a tax deduction where you're looking at, is it above the line or is it below the line? But it functions in the same way as an above the line deduction, where you take assets out of your IRA, your tax your ordinary income, it's income to you. So the QCD essentially lowers the amount of distributions that are taxable to you out of your IRA. And charities, for the sake of this presentation, public charities, which are typically 501(c)(3) organizations, not private foundations, which have different and less favorable donation deduction rules. Okay, so since a lot of this has to do with taxes and the benefits of donating from a tax perspective, just high level, kind of like how you go from your total income down to your taxable income. So not a comprehensive list, but mostly comprehensive here when we look at total income, your wages, your retirement plan distributions, your interest income from your investments, your business income if you own a business, your real estate rental income, and your realized capital gains. So you take that number and you subtract any above the line deductions, which most commonly are like IRA or retirement plan contributions, which lowers your income down to your adjusted gross income or AGI. Now, this is the line. When you talk about above the line, below the line, AGI is that big line. And so when you look at why AGI is so important, it affects so many different things. It affects how much you can contribute to an IRA if you're still saving in one. It affects, and I'm talking about AGI and modified AGI here. It affects your tax credits, your deductions. It hinges on how much you can deduct in medical expenses if you have a big medical expense in a certain year. And of course, the topic of this conversation it indicates how much you can deduct in charitable donations every year. And really below the line here is where you start to get very strategic and where I'd advise you to work with an accountant or a financial planner, whoever you work with in your circle who helps you with your tax planning throughout the year, because you can really, with some things, get strategic with how you're itemizing your deductions, or if you're like right at the standard deduction and don't have enough itemized deductions, then you can kind of get creative with it. So I'll talk about that later on. Just know that below the line, it ultimately comes down to, do you take the standard deduction or do you itemize your deductions? And that's where we eventually arrive at the taxable income. So with standard deductions and itemized deductions, I kind of like this analogy of this like IRS superstore, right? So they're giving you the standard deduction, which is essentially like a store-wide discount. So the IRS Superstore says, you know what? Like, we love all our customers. We're going to give everybody a 30% store-wide discount. So it's like, oh wow, that's incredibly generous of you, IRS. Um, but then you also have itemized deductions. And maybe let's liken that to like a VIP account holder at the IRS Superstore, right? So you've got these kind of like groups of little coupons that you can combine together. And so some years those coupons will be higher than the 30% off, and some years they'll be lower, or maybe they're right at it. So as you can see here, this account holder, assuming all of those are still valid, they can deduct up to, or they can combine their coupons to get 45% off, much higher than the 30%. So go right at it. Have at it at the itemized deductions. If they only have, let's say, those two 15% off coupons, so it's right at the store wide, you're better off probably taking the standard deduction, and if you can, using those coupons for another week, but really in the sense of the IRS, that's like another year, right? So some itemized deductions you can push off to next year. Others, they are what they are in the year that you're filing your taxes. Okay, so now with the different donation types, let's start with the easiest, cash, right? So you're handing physical cash or most likely some kind of check that you're writing to a charity of your choice. It's quick and easy. Cash donations are simple to document. You really just need a tax acknowledgement letter from the nonprofit when filing your taxes. It's best for people that just want something super easy. Maybe they're not making a huge donation, and so, or maybe they don't have appreciated assets to donate. And really the big benefit too of donating cash is you get the higher deduction limit with the cash donation. So as you'll see, the other types of donations have lower limits. So the nice perk about donating cash is you get to deduct up to 60% of your donation, 60% of your adjusted gross income in your donations. If you give a little, your standard deduction probably comes into play more than your itemized deductions, assuming you don't have any major itemized deductions to combine with the cash donation. So as far as tax benefits, you really need to make sure that if you're making a cash donation and you want the tax benefits, you really should be looking at your total itemized deductions to make sure you're receiving benefits for those. Okay, moving on to stock. So before we get into the mechanics of the stock donation, I think it's important to talk about short versus long-term gains. So put very simply, stock that you've held with short-term gains is stock that's held less than 1 year. These deductions, this is a very important point. So if you've only held your stock for less than a year, you can still donate it and you actually get the more favorable AGI limit at 60% like you do cash. But the big kicker here is you can only deduct what you paid for it. So if you paid $50 for a share of Apple or something, and if now it's worth 6 months later it's worth $100, you can only donate the $50 value. You can't donate the whole $100. So that's why short-term gain stock donations are not the best option if you have long-term to donate as well. So moving over to long-term gains, obviously stock that's held for more than 1 year, and you do get to deduct the fair market value of the stock that you donate. It's a lower limit with 30% of AGI, but it's much more powerful, and I'll show you kind of why here in this slide here. So an overview of appreciated stock donations. It's more hassle than just writing a check, as you'll see, but I'll walk you through the process coming up here shortly. The AGI limits are not as favorable as donating cash, but you get two big benefits of donating stock with long-term gains. You get to lower your taxable income up to 30% of AGI, and you get to remove stock with huge unrealized gains, capital gains in your brokerage account. And so I'll show you kind of what this looks like in this slide here, because I think this is a great kind of simple example. So let's say you own stock A and stock B, and you have your heart set on donating one, and you want to sell the other for some kind of personal expense. Maybe you're buying a car or something. Which do you sell and which do you donate? Well, stock A has 9,000 in unrealized gains because you paid $1,000 for it. Now it's worth 10. That's great. But you do have this gain coming up, this realized taxable gain if you sell it and use that for a personal expense. The best thing to do here is to donate stock A, and you avoid those 9,000 in gains and you receive the $10,000 deduction. Sell stock B for your purchase, and you only have to pay $1,000 in gains because you have that higher basis. You bought it for 9,000, and so you only have $1,000 in gains. Had you done the opposite, you'd be stuck paying $9,000 in gains from selling stock A for your personal expense, and you only would have gotten you only would have if you donated stock B, you would not you get the deduction, but you also don't get the benefit of getting a stock with high unrealized gains out of your portfolio. And just like one quick caveat or note here, I know we talk about 30% AGI limit, which is not as favorable as cash or short-term gain stock, but you do get to carry over unused deductions for up to 5 years after the year that you donate the stock. So it's a really nice perk that if you've got this big donation, you want to make it this year. You've got, 5 more years to make sure that you're reaping the benefits, the tax deduction benefits of a big donation. So right there, donate stock A, keep stock B for your personal expenses. And so how do you actually go about donating stock? Well, I will, first of all, caveat this whole process with this is how it works with Infinite Giving, the vendor that we use for our stock donations. And also too, when you'll see the forms that I show you with Schwab, the custodian that I use for my business, the forms will be a little bit different, but this at least gives you a flavor for how this whole thing works at a broad level. So first, we've got this giving essentially like button or piece of our website where you can go to decide on which gift you want to donate. If we look at the stock donation gift, it goes to this page here where you give basic information, your full name, your email, the firm that you hold your investment account with. Could be Fidelity, Schwab, Merrill Lynch, Morgan Stanley. You can write in a memo like what this is for, just to help kind of record keep all of this. And then your stock identifier. So most commonly, this is a ticker symbol. Stock identifier is like a catch-all term, but usually it's a ticker symbol or what they call a QSIP, just some kind of way to identify the stock in question that you're going to be donating, how many shares you want to donate. And then once you do that, you'll get a confirmation, or it'll take you to a confirmation page with instructions on how your custodian, again, Schwab, Fidelity, Vanguard, some of these firms, how they can actually go about transferring that stock. Now, it doesn't end here, and I'll show you why. But at the very least, this is from the website's perspective, PPF, Pet Project Foundation. This is how you at least initiate or pledge your stock donation. So you'll get this email from Infinite Giving. It'll be branded from Pet Project Foundation. So this kind of clarifies all of the information that the receiving custodian would need, which is Apex Clearing is the receiving institution, and so this is all the information you will need from them in order to actually complete the stock donation from your custodian. And so how does this look like as far as, okay, you pledged a certain number of securities from your brokerage account and you got the confirmation and everything, it feels like you're done. It's like, well, that you're done with the initial pledge. But in order to actually follow through with the stock donation, this is Schwab's version of a two-page form. I cut it up so you can see the main points here on the form. It's only 2 pages, so it's not super cumbersome. But this is essentially the way for you to not only link your account to the actual donation, but to also write in some of that, type in or write in some of the receiving clearinghouse, which you saw, Apex. And all of this can be done by you personally. It can be done by your financial advisor. You can call up the custodian's customer service and they can walk you through this. So however comfortable you are with this process, there's ways to like partner with your custodian or your financial advisor on this. But you fill out the receiving institution's information, Apex Clearing in our case. And then below that, you want to make sure that not only you're confirming the actual ticker, the stock that you want to donate, but what types or what lots. So the purchase date, the cost per share, all of these things will identify. So if you have like 100 shares of Apple and you only want to donate 10, and you want to donate the shares with the highest unrealized gains, this bottom part here is where you'll identify, okay, I bought Apple for $10 15 years ago, and now it's worth 100. Well, I also bought it last week for 90 and that has $10 gain. So you want to make sure speak with your financial advisor, but in all likelihood, you're going to want to donate the one that you bought for $10 years ago. So this bottom part here is where you go about doing that. And then after that first page, you'll see on page 2 some disclosure about like what happens from here once you sign and date this. You can either work with your financial advisor on completing this transaction, or you can work with as you can see, Schwab has like a phone number and a customer service line that you can talk to directly, just to make sure that all of this is getting executed properly. So it seems like a lot, but I just wanted to cover every single piece of this whole process so that at least if you see it again or come across it, it's not completely foreign to you. All right, on from the stock donation piece. Now let's talk about retirement accounts and how you can get from your IRA. QCDs, qualified charitable donations out of your pre-tax or traditional IRA. They start in the year you turn 70 and a half, or in the current year, they're good for the remainder of the account. You can give up to 108,000 in QCDs from your IRA this year. It goes up to 111,000. It's a universal limit, like I mentioned before, whereas RMDs are specific to the account holder and will change every year invariably. QCD limits are per account holder. So if there's 2 of you, husband and wife, you can donate up to $108,000 between both accounts. It doesn't have to just be one person does it. Pairing QCDs with RMDs. You don't have to, because QCDs start before you can need to take RMDs, but it's a popular way to donate, especially if you have RMDs that you don't need for your personal spending. So you've done a great job of building up your traditional IRA assets. And kind of the blessing and curse of that is you have these large RMDs, required minimum distributions, and maybe you don't need all of them for all of your annual spending needs. So and if you're charitably inclined, QCDs are a great way to give back and also offset some of the income tax liability that you'll have from your required minimum distributions. Remember, the RMDs or any distributions from your IRA are taxed at your ordinary income tax rate, not the favorable capital gains rate. So difference there. And it does. The QCDs aren't necessarily deductions, but they operate in the same way. So I mentioned that before. I think it's important to highlight again. One very quick reminder, your custodian, it'll probably vary by their service level, but a lot of custodians do not track what is a QCD and what is an IRA distribution. Schwab is actually working on this where they're being more diligent about acknowledging QCDs relative to broader distributions from the account. What I would say is that either yourself or your advisor or accountant should just keep logs of what are QCDs coming out of your account and what are just normal IRA distributions, because it's up to you and your accountant when you're filing your taxes that the QCDs are properly labeled. And as you can see, this person had to take out just over 93,000 in total IRA distributions. They made about 55,000 in QCDs, which you can see on the right is the taxable amount of the IRA distributions. And then the accountant here just labeled QCD to make sure that the IRS is understanding of what was going on there. Okay, donor advised funds. So donor advised funds are a really interesting tool for people that want the big upfront donation in the current year, but they also want control over the investments, and they aren't sure how many charities they actually do want to donate to. So if you know for a fact that you have a organization that you want to donate to this year, and you've got the money or the stock that you want to donate, easy, right? A one-off transaction, you get the benefits of the deduction, and it all works the same. But if you have let's say you have a high income year, you sell a business or you just have abnormally high income this year, donor advised funds are a great way to get the upfront deduction, but not being forced to make the donation right away. So you get the donation deduction this year via the donor advised fund, and you essentially invest the donor advised fund like it's any other investment account. And as you please over time into as many charities as you'd like, you can distribute those donations over time. So you get the upfront deduction and you have control over how it's invested, which organizations it goes to, and how much in donations those organizations get. They are subject to the same AGI rules as a cash donation or a stock donation. So just keep that in mind if you're considering a DAF. There's no different rules as far as contributing to a DAF, still subject to the AGI rules for cash and stock. Like I mentioned, especially powerful in a high income year, DAFs are. So charitable remainder trust. This one's a little bit of a doozy. So I'm gonna just I'm not gonna spend too much time on this, but charitable remainder trusts are an excellent way to give to a charity if a couple of other things align. So you're charitably inclined, you do want an income stream from a certain asset, and you want the deduction today or this year. So they're complicated. Charitable remainder trusts are complicated for a couple of reasons, but they can be a good fit for people that kind of match the overall criteria. So how does the charitable remainder trust work? Well, you transfer assets, often highly appreciated stock, real estate, or a closely held business, to an irrevocable trust. That trust pays out an income stream. It can be fixed or variable to you or some other non-charitable beneficiary for a set term up to 20 years or for life. At the end of the term, whatever is left over or the remainder goes to the charity that you selected when you set up the charitable remainder trust. These should be used on a very specific basis because most importantly, once you fund these, you cannot pull those assets back. So they're really stuck in the CRT. There are certain rules, very strict rules about payout rates to beneficiaries and how much the charity should get. It should get at least 10%. And the IRS's actuarial assumptions to determine the deduction are very complex. So you do want to work with an estate planning attorney to make sure that not only are these right for you, but you're setting them up properly in accordance with the IRS rules. But I did want to kind of bring these up as an option. And there's also charitable lead trusts, which are the opposite. The charity of your choice gets the income stream, and remainder beneficiaries receive the principal of the trust after a certain period of time. Okay, last and certainly not least, real property donations. So you got stuff around that you want to donate. Um, you can deduct the fair market value of the donation up to 50% of AGI. It must be in good or better condition per the IRS rules. You should receive a receipt from the nonprofit that you donate items to. Goodwill is an obvious beneficiary of a lot of these kind of tangible asset donations. If it's worth for more than $5,000, you should get it professionally appraised, and please do that before no more than 60 days before the donation. And you must not receive anything in return for the donation in order to receive a deduction off your taxable income. Okay, bringing back that just simple kind of calculation for how we get from total income to taxable income. So I just want to point out where these deductions actually fall. So you see that qualified charitable deductions aren't this right here, the above the line. They're just an offsetting measure to your taxable retirement plan distributions. So if we look at all of these, they're the most powerful from a tax perspective because they reduce your income above the AGI line. And all these others really come into that itemized deduction. Cash donations, 50% of AGI, appreciated stock, 30% of AGI, or 60 if you donate short-term stock. Real property donations, 50% of AGI. I added donor advised funds and charitable remainder trust here. Just know that the rules for donations, as we talked about, are subject to the AGI limits for number 4 and 5, DAFs and charitable remainder trusts. So the rules are related to 1 through 3, really 1 through 2. But I just wanted, in case anybody was wondering where those actually fall, they fall in the itemized deduction line as well. And let's look at Felipe. Oh, I'm a sucker for pit bull mixes, so I love Felipe, and he got adopted last week. Okay, so two really important rule changes from the One Big Beautiful Bill Act, which was enacted in July this year. One rule for standard deductions. The pre One Big Beautiful Bill Act rule was that taking standard deductions would be ineligible to deduct any cash donations. So if you didn't have any big deductions, if you didn't have any big cash donations, then you couldn't donate anything essentially, or it wouldn't benefit you to itemize because your standard deduction was so high. So, but now the rule is that if you're making a cash donation up to $1,000 as a single filer or 2,000 as a married couple filing jointly, you can deduct those small donations without any consequence of, is this enough for my standard deduction or enough for my itemized deduction relative to standard deduction. So it's a nice bonus, I would say. Like it's not really moving the needle from the donate tax deduction perspective, but it is nice to know if you're giving $600 per year or $1,500 per year as a married couple, that you do get the benefit of the deduction. You're not trying to hustle to put together all these itemized deductions to reap the rewards of that. So small donations work in your favor regardless of how high your itemized deductions are. The other rule in relation to itemized deductions, this one's kind of unfortunate, but it's not a big penalty. So before the OBBBA, there was no floor on charitable deductions. So all that we've talked about here so far, you're just subject to the AGI limits when you donate cash, stock, or tangible property. But next year, and both these rules are starting next year, 2026, with charitable donations, there is a 0.5% floor for donations. So the first 0.5% you can't donate. And if you're familiar with any of the kind of current IRS laws, it was earlier in my slide, but you cannot deduct any big medical or dental expenses below 7.5% of your AGI. So there's essentially you got to have expenses that are above that in order to qualify for deductions. This new rule is the same thing, except just a much smaller floor, the 0.5%. So if you're making, tens of thousands of dollars, even 100 or $150,000 in donations, it has like a small impact on it. But if you're making, huge deductions, hundreds of thousands, if not, millions or more, that's where this stuff starts to come into play. If you do fit that bill and you're thinking about making a large donation this year, or I'm sorry, next year or following years, and you have the flexibility to make the donation before this year's end, the floor goes into effect next year. So again, talk to your financial advisor or CPA accountant on whether you should think about this. But people who are charitably inclined and they're making big donations, there is no floor until 2026. Okay, so to wrap this up, I just want to kind of recap when you should consider each. So cash donations for those with little to no appreciated assets like stock or other securities in their investment account, and or they want minimal hassle. Cash is a really quick and easy way to donate. That it has the nice benefit of a higher AGI limit of 60% of AGI. Stock donations, attractive for those with high unrealized long-term capital gains, likely from a stock, maybe a mutual fund or an ETF. Lower deduction, but still deduct up to 30% of your AGI with long-term stock donations. QCDs, really the most powerful of these when you look at the impact on your taxable income because they're above that AGI line. You can start these in age 70 and a half. Why it's half, don't ask me, it's the IRS. But you can start those in the year you turn 70 and a half. For years that you take RMDs, it's a really powerful way to offset income if you're already charity inclined and if you also don't need your RMDs for your personal spending. 108,000 is the limit for QCDs. Next year it goes up to 111. Donor advised funds, you get the large deduction this year, but you want control over how it's invested, when it's donated, and to which charities over time. The donor advised funds are subject to the same cash and stock donation limits, AGI limits, so nothing changes there. Donating real property, you've got valuable property that you want to donate. Ideally something that's valuable over 5,000, a little more maintenance to kind of track and keep records of that, but probably worth it if you're going to just get rid of it anyway. And then charitable remainder trusts. You have a highly appreciated asset. You need an income stream. You want a big deduction for a high income tax year, and you're already charitably inclined, and you don't mind the added complexity and costs of working with an estate planning attorney on setting one up. So with that, I will open up the floor to questions. Feel free to unmute yourself, chat your question, type a question in the chat box, whichever you feel comfortable with.
Dan, this is Denise. I just wanted to say thank you. This is extremely helpful.
Of course, Denise.
Especially the new info from the One Big Beautiful Bill, and then how to actually donate stocks is extremely helpful. And that also applies to inherited stocks, correct?
Yeah.
Like same rules.
Yeah, correct. Yeah. So with inherited stock, it's a little tricky because if you're inheriting stock from, let's just say, I'm trying to think here. let's just say you're inheriting stock from a classic brokerage account. So because I'm thinking like, the rules for a revocable trust are different than an irrevocable trust. But let's just say, for simple purposes, that I inherit a stock from someone from their taxable account. So what we didn't get into here is that if you inherit stock or many assets, I want to say all, but if you inherit securities from a taxable brokerage account, that gets what's called a step up in basis. So if you bought
Right.
Apple at $5 and it's worth $500 now, and you pass away, your beneficiaries get the benefit of the step up to where their cost basis is now $500. So in a sense, you could donate, but at the same time, if you have other securities with bigger gains in them, unrealized gains, they're probably better candidates to donate because your cost basis, it's almost as if you bought it the day that your loved one passed away. So, of course you can, but and also the inherited IRA rules are a little bit tricky too. So there's like rules for taking distributions from those inherited IRA accounts over within 10 years. There's RMDs for those now too. That's a new rule change. Um, but you have some options, I would say. Just I'm generalizing, but it depends on the situation and what options you have to donate if you're charitably inclined.
Awesome. Thank you very much.
You bet. And thank you for your support, Denise.
Um, I've learned so much.
Oop, that question here in the chat. Let's see. Oh, no problem, William. And just a heads up, if you know of anybody who missed it, I'm happy to send them a replay. I can't promise it's going to be done soon, but I hope to have this uploaded to Pet Project Foundation's website at some point or some link to it. So, and we'll try to make this a regular occurrence so where we just revisit these, especially if there's some new tax law that comes out. I think it's important to just kind of share the updates because, man, I'd say one thing that's really difficult is like trying to educate yourself by Googling certain topics. And I'll tell you right now, like a lot of articles you might read might be based on old tax law. So just tread lightly there. But if anybody has any questions, beyond this, I'm an email away or a call away. Happy to help you out. I offer complimentary calls with my business. So if you want to bounce some questions off me for a half hour, 45 minutes, I'm happy to do that as well. All right. Well, if that's all for tonight, let me just double check. Yeah, I think that's it. I hope you all have a wonderful night. Happy Giving Tuesday, and hope you guys have a wonderful holiday coming up and a nice strong finish to the end of 2025. Where's the time gone? So thanks a lot, guys. I appreciate it.
Thank you, Dan.
Sure, no problem.
Thank you.
Thanks, Dan.
No problem, guys.